What's up, you bunch of beautiful meatballs? It's your boy Trey, back again for another video. This one's not going to quite be 30 minutes long, but as you can see by the title, this is part 2. I said yesterday that I was going to continue on with the big squeeze theory, and I wanted to leave people some time to digest the information that I discussed. And today I want to dive into not necessarily the market maker mechanics and why I believe this to be the case, but more so what I think this situation would look like. As always, I'm not a financial advisor. This is not financial advice. Please take it with a grain of salt. Do what you got to do, right? I'm not here to tell you to buy. I'm not here to tell you to sell. You're in charge of your own finances. That's it at the end of the day. In case you missed yesterday's video, this is going to be in a playlist, but I'm going to give you the TLDR. This is basically the big squeeze theory. This is contingent and partially tied with, I would argue, Astro's video. He had a video called the short squeeze weapon. And to give you a TLDR, in case you don't want to watch the entire video, I believe retail is losing the options game. I don't think that that's a false statement to make. I think the data would prove to you the exact same thing. And I think that it's a fixable issue. And this is personally, in my opinion, how market makers manipulate the stock. I go over the details of that. If you'd like to see that, go watch the first video. It'll walk you through in pretty great detail how I think that is possible. I also believe if retail changes their strategy, two things are going to happen. Implied volatility will rebalance, changing how the algo moves the stock. If you don't know what implied volatility is, it means that market makers think that a stock, according to that implied volatility, will go up or down that percentage number in one trading year's worth of time. So a high implied volatility, if you were to convert that, means you are paying more for a contract, right? High IV equals high contract price. That's just the equivalent. That's what it means. Low IV means a lower contract price. The second thing that I think will happen is this. A hedge, when called for, will accumulate money in retail hands. Now, the big takeaway and the big thing that I think people are controversial about, and justifiably so, right? I absolutely 1,000,000% accept everything that people have to say right now because I expected it. I expected this to be a controversial topic and not an easy concept to sort of swallow. But a hedge, which is much different than a trade, by the way, a hedge, when called for, will accumulate money in retail hands. Now, I want to go over all these different things in great detail. But before I do, let me just tell you what the value of buy and hold really is. In no way, shape, or form am I here to tell you to buy or to sell, regardless of this previous video. Right? There is true value in buy and hold. And when I say that, I really do mean it, because buy and hold is what allowed retail to be able to take a step back, look like this, and say market makers are without a shadow of a doubt manipulating stock price via the options chain and via derivatives. That is a provable thing. Buy and hold has allowed retail to know that there is a liquidity crisis, meaning retail owns 90% of the float of AMC. Institutions own about 36%. ETFs take up a portion of that. And there are likely synthetic shares that circulate around on a day-to-day basis from market makers and potentially some hedge funds as well. Buy and hold is great. In no way, shape, or form am I telling you not to do that or telling you to do that. I'm not here to tell you to buy or to sell. What I'm here to tell you is some information and some statistics and some data. Let's check this out. I want to dive into historical flow. If you look at the call-put ratio over the previous 9 months, right? Let's just go back all the way to June. I have something pulled up. The website is called Market Chameleon. By the way, Tyler Wilson, I appreciate you. He told me to log into this website. I went into this and I didn't realize all I had to do was log in and I'd be able to see all this stuff. I thought I had to pay for it. I'm not a fan of these fucking paywalls, man. I'm too cheap for that. But anyways, I've got something pulled up here. It's a 30-day implied volatility. As I just mentioned before, IV directly correlates to the price of a contract, whether it's a call or it is a put. And there's two things that you're going to notice here. You're going to notice that if you line this up with stock price, implied volatility spikes every single time that there is an increase in stock price. This makes sense, right? If you think about it, implied volatility is priced on two main things. It is priced on one, volatility, right? I mean, implied volatility is in the name, and two, demand. So if the volatility is one of these things and you see volatility go up, as when we ran to $70 back in June, you'd expect implied volatility to also go up. But as I just mentioned, there's a second factor at play here, and that is demand. Demand also plays a role in implied volatility. And what you're going to notice is that even though the stock price went down and started to actually slow down its rate of decay or rate of falling, whatever you want to say, the implied volatility stayed pretty constantly high. The only time that we've really ever seen some massive runs, by the way, is when implied volatility was very, very low. Back here, you can see that it was nearly at 100%, which is the lowest that implied volatility was for quite some time, since January of 2021. And back here, when we also tap back down to 100%. This means two things. Inherently, if implied volatility is controlled by demand and by volatility, it means that we had a lack of volatility and a lack of demand for the upside of options contracts. You come over here, you look at the stock price, that does appear to be the case. You had a lack of volatility, and you also had practically the lowest amount of demand for calls that we had seen in quite some time. In fact, that you look back at this, and you're going to remember that a lot of retail investors, a lot of apes, were thinking there was going to be downside to about $12. That's just the truth of it, right? They thought it would go down to 12, 11, 10, $9, whatever, which means that less people were buying. Less people were buying calls, which resulted in the lowest IV that we have seen in quite some time. So knowing this, right, I want to discuss something that I find to be quite fascinating, and it is the call versus put implied volatility. One thing that I don't think a lot of people talk about is that there can be a difference in implied volatility for contracts for both calls and for puts. If there's more demand for a call contract, you're going to see an overall higher implied volatility, which, as we just discussed, results in a higher overall price for the contract, right? With that being said, if there's less demand for puts, you would expect the exact inverse. You would expect cheaper contracts to be had for puts. Makes good sense, right? So let's just check this out. If you were to look at this is puts right here, and we go 4 strikes out the money. This obviously is not completely correlated, but you're going to notice one thing. You're going to notice that 1, 2, 3, 4 strikes out the money. You have about 145% current implied volatility and a cost of about 22 cents per contract, which comes out to $22 in total. If you were to go 4 strikes out the money for a call right now, what you're going to notice is 1, 2, 3, 4. It is 164% implied volatility and 43 cents, which is nearly twice as expensive as the equivalent in a put. Now, why is this the case? That brings me back to the historical implied volatility chart. I want to show you guys something. Since June, you have seen not a single week in which there has been more bearish flow than bullish flow. And you're going to notice this down here, call volume versus put volume. Why do I find this to be important, right? Let's just check this out here really quick. Well, bullish flow, bearish flow, unusual whales, all this stuff is supposed to really give you an idea of when a stock is looking bullish. If you see more bullish flow than bearish flow, you'd expect the stock price to go up, right? Well, not necessarily. Check this out. This orange bar right here, orange equals call volume. The blue stacked on top equals put volume. What you're going to notice every single week is there has always been more call volume than put volume. Why is this the case? This is my theory. I can't prove, exactly who's buying these contracts at the end of every single week. All that I can do is take an educated guess. But my educated guess is one simple thing. I think retail and a small minority of institutions, hedge funds, perhaps market makers hedging, who knows? It could be a whole lot of different things, buy these contracts. What does this tell you? It means, unfortunately, retail's been losing. It means we're losing. And what happens when retail is only buying calls the entire time the stock goes down? Implied volatility stays juiced. If I erase all this and you were to look at this right now, you're going to notice that implied volatility stayed very high for a prolonged period of time. I would argue much longer than would be typical for a stock that's in a 9-month downtrend. And it's because of one simple thing. Even if volatility went down, it doesn't matter. Because demand never did. Demand stayed high. Of course, you have a huge spike in call and put premium here back in June. You have a spike over here as well, as there was a huge run up. But for the most part, I mean, what you're going to notice is there's been almost the same exact level of call put ratio, call put volume for 9 months. Where does that money go, right? When a call expires worthless, it goes into market maker hands. You lose it. If people are willing to pay for the implied volatility of a contract, why would you change the price? Why would you change the price? If somebody's willing to pay $10 for a loaf of bread, why would I charge $2? I mean, if you want to get to the ethics of it, I don't think that's very, I don't think that's very ethical. I don't think what market makers do is very ethical. But from a business perspective, these guys are like, well, fuck. If these guys are going to pay for it, why would we change the price? It just makes sense. That's what it is. And what you're going to notice is when we got the run up in price is when call and put volume was the lowest that it had ever been since June. Why? You had no volatility. You had a lack of demand. What happens when you have a lack of demand? You have a lack of volatility. The algos step into the equation. And this brings me back to the historical flow of the stock. This is actually something that I would like to see Unusual Whales do. So if you guys want to tweet this at him or whatever, I'm probably going to reach out to him personally. But let him know if you want to see something like this. I think if Unusual Whales wanted to take it to the next level, what he could do, very simply put, is compare the current implied volatility of any option that is being pushed on Unusual Whales to the historical implied volatility. And if you see that the current implied volatility is much lower, but all of a sudden there's a huge slap up in volume compared to the historical implied volatility, that is almost 10 times out of 10 going to be a great buy because that shows you a unusual trade. That's a great sign. Like if you look over here, for example, you notice that out of nowhere, you have this huge downtrend in call versus put premium rolling in. And then this huge spike, well, you know what's going to happen. You know what that is. That is a sign that you have an imbalance in demand leaning towards calls. You have more people, specifically algorithms, that are now leaning towards the bullish side instead of the bearish side, and that the price is likely going to go up, right? That just makes sense. Which brings me to my next thing. If you look at all the historical implied volatility, you look at sort of the way that supply and demand works, that volatility affects the price action, how it affects the way that these get priced in and how algorithms are able to move the stock. Please watch my first video. It'll walk you through the entire process and how I think the market maker algorithms manipulate the stock. What is there to say? The money lost on contracts, to me, does two big things. One, it pisses money into the abyss. It is a wasted opportunity for people to be able to positively impact their lives. And two, it creates a gambler's mindset. Now, this is a hard pill to swallow, but I'll be the first to come out and say, right? I have made poor options trades. I made emotional trades. And it's very easy to do. And when you put yourself in a constant state of emotionality, you are going to view a ticker, a chart in an entirely different manner, a community in an entirely different manner, and money in an entirely different manner. Because all that we view things as right now is green equals good and red equals bad. And there are ways to protect ourselves from this. So the moral of the story to me is people say, Trey, if we change our strategy, market makers are just going to adjust. We're just going to lose. Retail's been losing. We've been losing, but it's just the truth. It's a really hard fucking pill to swallow. I hate having to say it, but the data's here. You have not seen a single week since June in which retail has not had more calls than puts, And I think this is my theory. This is the icing on the cake. Is I think that market makers use implied volatility to pick which side to lean towards when calls are cheaper, which they're currently not. And let me tell you, okay, even if today was green, if today was red, wouldn't have made a difference towards my theory. This is not some sort of I told you so in the least bit. Don't interpret it that way, because I think it would take 1 to 2 months to even be able to validate whatever I think it could potentially happen. It's not validatable in a single day. Today could have been 10% green, and I still would have been saying the exact same thing. With that being said, market makers want to lean towards whatever's cheaper. Their algorithms are programmed, and I'm going to write this out just so that it's memorable, right? Memorable, whatever. Their algos are programmed to just buy or sell what is the cheapest. That's it. You see that puts are cheap right now. You see you can buy a 22-cent forward strikes out the money put versus a 43-cent call. Algos probably lean that way. That's just how it is. That's how they work. That's how these algorithms are programmed is, all right, this is cheaper. There are not people loading into this, so let's push it down. This is cheaper. Calls are cheap. Nobody's loading into this. Let's push it up. That's how these things work, you know? Which brings me to my next thing. So what, right? So what? I think there's three main takeaways, and I think there's three things that retail can do to improve sort of our situation and understanding of options, because options are not inherently bad. Options have helped retail get to the situation that happened back in January, happened back in June, created GameStop, created Ader, created SPRT. None of those things would have been possible without options. But we can sharpen the sword. You can sort of change the way you can sharpen the method, right? That's it at the end of the day. There's three things for me. One, lotto calls. And in no way, shape, or form am I disrespecting Rico. I checked in with him before. I stated this in the video, and we actually had this talk one-on-one last night for quite some time. Lotto calls, to me, are not a good thing. Lotto calls are dangerous. They create a bad mindset. It's the question of what if this could happen. In no way, shape, or form should we associate what if with this stock or with any stock. I don't think it's healthy to put yourself in a situation where you have an itch, where you need to look at the 1 minute chart, where you need a certain price level to hit at a certain time. That is unhealthy. You can't maintain that. That puts you in a state of emotionality, and it creates too broad of swings in the way that you're going to view the chart. It's going to turn you off. It's not sustainable to have those sorts of high swings and high and low lows back and forth, back and forth, back and forth. I don't think it's healthy, right? And I think this is something that happens. And let me tell you, I've got a lot of love for Rico, but I only mention this because him being a good friend of mine was up a couple hundred G's and ended up walking away, you know, in a whole different state of mind than was possible. And to me, it was avoidable if it weren't for lotto calls. He knows that. I know that, right? It seems like it makes sense. But this happens far more than I think that it should. I think that's an unhealthy thing for people to ride on. Number two, lack of education. I don't think the answer is to just step away from options. The answer isn't, if I don't understand something, let's just tell everybody not to do it. The answer is education, and it almost always is in every single situation. To me, options are only a bad tool if they're used wrong, if they're used in a bad way. If you wanted to go hammer a nail into a block of wood, right, but you're using like a fucking can of Coke, well, duh, all you're going to do is crack that can of Coke open and spray it all over your face. You're going to be pissed off, of course. You're using the can of Coke wrong. You should be using a hammer, whatever, right? In this situation, I think for those who maybe want to use options or are using options but don't know, we have to solve that problem. There is an undeniable fact, an undeniable statistic that retail plays options. It's just there. AMC is one of the most heavily traded derivatives markets in the entire U.S. stock market. This thing sees volume like fucking I don't know, like an ocean full of fish, and they're getting made into fish sticks. That's a lot of fish sticks, right? You got a lot of fish sticks on this chart, dude. It's a lot of volume. So the education is going to be huge, because the moral of the story here is people are going to play options no matter what. They are. It's just, we cannot debate this. This is just fact. Whether we like it or we don't like it, this is fact. It's fact. It's absolute fact. It is. So education is the answer. When you don't know how to play options, I think it's okay to take a step back. I think you should take a step back. And if you do know how to play options, that brings me to my third point, Perma bias. And I think a great analogy that I have for this, very simply put, are whales in the economy. Now, there are bad whales out there. There are whales who genuinely just want to see the economy fucking burn to the ground. But I think there are also whales, maybe less than the bad ones, but there are whales that want to see the economy grow. They want to see businesses thrive. They want to see the evolution of man and woman continue to turn the gears. It makes sense. Why wouldn't you? But at the same time, there are also moments in time in which the economy that they love and want to see grow is in a state in which it is not possible to make money by being a bull. It's the truth. Are they going to take away their perma bull bias? No, they want to see the economy thrive. They're going to continue to play the bull side of things, but at the same time, they do a hedge. They hedge for the downside, anticipating the pressure while also believing in the stock. A great example to me is Tesla, right? If you believe in Tesla, you think Tesla is a fantastic company, and you want to play it as a bull. I can guarantee you one thing. I can guarantee you that if you were playing calls throughout all this, it would be very difficult to make money. It'd be very hard. It'd be difficult, right? If you want to be sort of a bystander investor and all that you're doing is buying and holding a stock and you never look at the chart except for maybe once or twice a year, that's beautiful. You can do that. You can do that. But I don't think it's healthy to be watching the chart every day if that's what you want to do. If you're watching the chart every day and you're trying to make money on a day-to-day basis, you're hoping for something on a day-to-day basis, I think it's good to protect yourself by hedging. And this does not mean full porting. And this brings me back to my whale analogy. Whales will hedge even if they have a perma bull bias. They will know that the economy that they want to grow is in a state for the next, I don't know, maybe 1, 2, 3 months. Let's just say this is 2008 or something, right? They'll look back at 2008 and say, this is obviously fucked. This is terrible. I mean, things look terrible right now. It's going to be really hard to make money as a bull for the next year. So what they do with their perma bull bias, them knowing that they want to see the economy continue to grow, will make money by hedging for the downside until the bullish market returns. I think if we can fix these three things, the lotto call mindset, the lack of education, and the perma bull bias, this stock will fundamentally shift. You will literally get to see in front of your eyes the algorithm from the market maker buy and sell this stock differently. Without a shadow of a doubt. If 3 months from now, we see this call put ratio change so that it actually matches the supply and demand of the actual stock, you are going to witness the way that this stock trades literally fucking change. Without a shadow of a doubt, I can say that with the utmost certainty in my mind. And I want to bring it into this. What would happen? These are two scenarios to me that I've got painted out. What would happen if those who don't know options sat out and those who do played the chart and not the bias? It's very simple to me. Number one, IV rebalance, implied volatility. And to me, the most simple way, if you don't want to look at implied volatility or any of the mechanisms behind that, think of it as an algorithm rewire or the way that the price actually moves. See, if market makers, and we accept the theory that I'd mentioned in my previous video, if market makers are simply looking at calls and puts and which is cheaper, right? And they're looking at puts right now and they see that these are cheaper because both of these things are moved by two things, volatility and by demand. And if calls have way more demand, which means they're more expensive, market makers lean towards puts, right? Well, what's going to happen? They're going to lean towards puts. The stock price will go down. Why is this the case? Why are calls more expensive? It's not because of volatility. It's because of demand. There's a lack of volatility that has happened over the last 9-10 months, but calls stay expensive while puts stay cheap. And it's because nobody buys puts. In this scenario, it makes sense for the market makers to push the stock price down because that's just cheaper. That's what their algorithms are literally wired to do, is to make them money. Is it ethical? Is it right? No, I think it's manipulation. It's fucking awful. It's crooked, but that's the game. It really is. And until we have more money than market makers, you can't change it. You will get to watch this absolutely change. The IV rebalance, meaning how much it costs for a call and how much it costs for a put, will change to actually match supply and demand based on what the chart says. Number two, you keep more money in your pockets and you get to accumulate shares. Now, this doesn't mean that you should be full porting puts. I think that's stupid. I really do. I see people on Twitter quoting, that portion of my video, that 30 seconds of my video, and saying, Trey's telling everybody to buy puts. Listen, what I genuinely want for people is to make money, to be able to wake up in the morning and no matter what the chart is doing, be happy. Not because it's green, not because it's red, to be able to sit there as a perma bull, as an ape, as a fucking man of retail or a woman of retail and say, you know what? I know that 6 months from now, a year from now, a year and a half from now, my stock is going to be worth more than it is right now. And that today it's okay if it's red because I am hedged. I'm protected against that downside price action. It is not inherently bad to protect yourself. If you're gonna full port puts, don't even fucking bother. That's stupid. That's dumb. Oh, that makes absolutely no sense, right? This comes back to what I mentioned before, which is that lottery mindset. You're trying to make a quick buck, right? But if you're hedging and you understand how options work, you protect yourself. If the stock goes down, you're hedged with a put because you understand how charts work. You understand the mechanics behind options. You're looking at implied volatility. You really have a full understanding and a grasp of how things move, right? And you've hedged. Well, you just made money on your puts. So when it finally bottoms out, you cash out on your puts, you have made your money. You have not lost a dollar. Your happiness and your emotionality is not dependent on green is good and red is bad. That is not sustainable. Let me tell you something. The thing that is maybe the most sad over the past year and a half, and this is the genuine truth, is how many people have left because of the drastic shift in emotion of the ups and downs of the way that this stock moves, because it's avoidable. I really think it is. I think that this is drastically avoidable by simply protecting yourself. You are not going to have a bad day if you are hedged with a put. If the stock looks bearish and you can see the chart and look at it and say, this looks pretty bad, and you decide to hedge with puts, right? You're going to be protected. At the same time, right? If we look at a chart and we say that it looks good and it actually genuinely looks good, and you play calls that are not lottos, these things fall into the same category, right? You shouldn't play puts as a lotto. You shouldn't play calls as a lotto. You shouldn't hope for the best and expect the worst, right? You want to set yourself up for the most success possible. If you're genuinely playing the supply and demand and the chart setup and no bias, while also maintaining the stance of I think that this stock can have a nice move, you're never going to have your happiness sit on something that you cannot physically control, which is the way that the price moves on a minute to minute, hour to hour, day to day perspective. I genuinely think that. I think this is a good thing. That was a lot to unpack. I wanted to be able to dive deeper into the theory. I spent most of the previous videos sort of explaining why I think market makers are big pieces of donkey shit. and I wanted to dive into more of the theory itself, what I think retail can do to sort of improve the situation. Because there's lots of people who get it. There are some people who don't. And I'm not here to judge or blame any of you. At the end of the day, this is drastically different. I've never even mentioned anything like this. So please, coming from me personally, if there are those who disagree with me and you agree with me, don't bully anybody who disagrees with me. I want no beef with anybody. I genuinely don't. What I want for everybody is to see this change, this wasted money, this pissed away money. Because at the end of the day, we can say one thing with absolute certainty. Options helped create and were a big part of every big move that AMC has had, every big move that GameStop has had, and every big move that any meme stock has had. They're essential, but it has to be done right. We can't be playing lottery tickets, and when we're not in a bullish situation, we have to protect ourselves. It's that simple. I really do genuinely think that's what it is. I think we just simply have to evolve. So my final thoughts, right? Education. I think if you want to learn about how charting works, how options work, I have a video that I can even link in the description box down below. But it is called the Options and Charting Masterclass. It is right here for you. It's an hour and 20 minutes long. It's lengthy. If you want to take it in chunks, feel free to do so. I think it is helpful. I think it's going to teach you a lot of things. If you don't understand options, I personally believe it is best that you don't play them. I don't think it's a good idea. And at the end of the day, if you're not interested, listen, just buy and hold. I really think that's okay, but you shouldn't be paying attention to the day-to-day price action. I don't think that's for you. I don't. I think we have to take out the emotionality and the day-to-day sort of swings behind the way that the stock moves. If this is the perspective that we want to take of just passive investing, that's okay. I'm absolutely chill with that. That's a good strategy. That's totally fine. If you like tools, I have crossover indicators in my Discord. They're absolutely free. My Discord will always be free. And we are going to be adding AMC and GameStop to these so that you can track sort of the way that these stocks move on a bunch of different time frames. I'm not telling you to buy or sell calls or puts, stock, whatever. At the end of the day, it's a tool that is there for you to do whatever you want to do with. And at the end of the day, I think if you want a real MOAS, I went over this in my previous video. There's two scenarios here. I think scenario one, which is where we're currently sitting, I think you see rips, huge rips, followed by long periods of slow bleeds. I think that's just the way this is going to squeeze. I think it's going to be a lot like Tesla. I think scenario 2, which is the retail scenario where we kind of clean up the game a little bit, right? We clean up our act a little bit. Scenario 2 is a more clean Tesla squeeze. Rips, followed by dips, but not shadow realm dips. There'll be supply and demand based dips where you can see physical growth in the company. And I'll tell you what, if there's one thing that I would be genuinely happy with, satisfied with, it would be to see this company, AMC, look like a fucking contender on the chart. I think that would be the most sexy thing ever, to be able to take a step back and say, holy shit, look how far retail came. I genuinely think that's possible. That's my thoughts on this video. And if you have any more questions, I think I addressed most of the things in the previous video. I read the comments very closely. That's where a lot of the topic of discussion came from today. I want to be able to really dive into it in great detail. If you have any more questions, please drop them down below. Be respectful to each other. If somebody disagrees with me or you, be good people, right? Love your neighbor, whatever. And that's what I've got for this video. So I'll catch you all later. Appreciate you. Much love, late taps. Peace.